In the past decade, Netflix has revolutionized the way we all watch shows and movies around the world. What started as a subscription DVD rental service that was created to take on Blockbuster has turned into a multi-billion-dollar global entertainment company with over 200 million paying subscribers around the world. Not surprisingly, Netflix's stock has had one of the best returns of the S&P 500 in the past decade, with an average return of over 36% per year. Even though Netflix has been an entertainment powerhouse and stock market favorite in the past, we must look to the future to see what return we can expect for Netflix's stock in the next decade. Netflix's business model is pretty simple. Instead of providing content through a transactional model like most other companies in the past, they rely on a subscription model for almost all of their revenues. Netflix plans and produces content several months to years in advance of the expected release date, and there are no direct revenues they can count on when the content releases. Instead, Netflix tries to create the most valuable service they can for their existing users, which eventually will help draw in new users from word-of-mouth advertising and having better content overall. As they increase the value of their service, they can also increase subscription prices once they know that consumers are willing to pay more for the increasingly better service. So basically, Netflix has flipped the entire entertainment industry on its head, since they rely on growing subscription revenues and low churn rates to finance more content and grow their earnings. Now we'll take a look at Netflix's key ratios over the years. Here's a graph of the debt-to-equity ratio over the past 10 years. As you can see, they've been taking on more debt due to increased content production. It can take years for Netflix's content to become profitable, so they've been building up the value of their service so they can attract new subscribers and fend off the competition in the future. The next ratio we'll look at is Netflix's operating margin. Here's how the operating margins have changed in the past decade. Past ratios are not the best metric for valuing high-growth companies because the focus is on future growth instead of present-day financial numbers. As you can see, the operating margins have varied throughout the years, but they're trending upwards. Netflix aims to increase their operating margin by about 2 to 3 percentage points per year over the next few years. So we can expect that Netflix's operating margin will end up around 25% in the next few years and will stay there for the long term. Now we'll talk about Netflix's economic moat and management team. There's a lot of things that help Netflix fend off the competition, but I would say that Netflix's moat is mostly made up of their intellectual property and the stickiness of their product. If you want to watch a show like Tiger King, the only place in the world you can legally watch it is Netflix. Nearly all of Netflix's content is exclusively distributed on their platform. So if you like even 1 or 2 shows, you have to become a Netflix subscriber. Better yet, since almost all of the content on Netflix is produced by Netflix, they don't have to pay other companies to attract and retain users. The other part of Netflix's moat is the stickiness of their product. Netflix has one of the lowest churn rates in the industry, with only 2 to 3% of subscribers canceling their subscriptions in any given month. This churn rate is lower than every streaming service in the industry. So basically, consumers enjoy and get a lot of value from the Netflix platform, which gives Netflix pricing power to increase their revenues without necessarily producing content at a higher rate. Now we'll take a look at Netflix's management team. Netflix's CEO, president, and chairman of the board is Netflix co-founder Reed Hastings. Hastings has been with Netflix since creating it in 1997. It's safe to say that Hastings has made some excellent decisions for the company in the past 20 years and was able to transform it from an online rental DVD company to the global entertainment producer of today. Hastings also has significant skin in the game, owning over 2% of Netflix's stock. That might not sound like much, but he is in fact a billionaire worth over $5 billion in Netflix stock. About half of Netflix's current executives have been with the company since the very beginning. Reed Hastings is given a $700,000 salary and over $37 million worth of stock options a year. This pay is on par with the industry averages, and he is the founder, so his goals for the company are aligned with shareholders. The rest of the chief officers are compensated about half with salary and half with stock options. I believe Netflix's management is extremely skilled and able to create long-term value for shareholders since they are entrepreneurial at heart. They have said time and time again that they are builders and not buyers through acquisitions. They even give employees generous pay packages to quit if they feel like they aren't contributing enough to building the company. Let's look to the future to try to see how Netflix will perform in the next decade. Here's my Netflix thesis for the next decade. Netflix will achieve growth in the emerging markets, while the growth rate in the developed regions more or less levels off after the first few years of the decade. Netflix will successfully be able to fend off competition and will be the dominant streaming service in the industry. The competition will still exist and grow, except it will be a complement to Netflix's service, where consumers pay for both Netflix and other streaming services. The market is expanding. Netflix and other streaming services aren't just fighting with each other, they're also fighting for people's screen time. Since the time spent on television and through traditional entertainment is declining and is instead moving toward digital and especially mobile usage, Netflix will continue to dominate the industry and successfully penetrate new markets around the world. Using that story for Netflix's future, we can try to estimate Netflix's growth in the next decade and calculate the stock's intrinsic value. Netflix just passed over 200 million global subscribers, which makes it the largest subscription streaming service in the world. As of 2021, Netflix expects that they will become free cash flow positive after this year and will not have to raise additional debt or equity to finance the operations of the business. The global total addressable market for the streaming industry is expected to be around 1.1 billion people for the next decade, due to growth in the global middle class and new emerging market penetration. The streaming industry as a whole is expected to grow between 15 and 20% in the next decade. Netflix has already started to see lower growth rates in North America, yet the markets in the rest of the world are still in a high growth phase. Due to somewhat low expected growth rates in North America and high expected growth rates in the rest of the world, I expect a growth rate of 15% in the next 6 years and 10% for the last 4 years as the growth in the rest of the world slows down to what North America is experiencing. As mentioned before, Netflix also has pricing power, so I expect them to increase the global revenue per user by about 3% per year over the next decade. Now that we have the growth rates, we can calculate the intrinsic value. Since Netflix's revenues are from all around the world, I've calculated that the discount rate for Netflix should be about 6.5% when you consider the risks of some emerging markets and the fact that the US 10-year risk-free rate is 1.1%. I've also assumed that Netflix's operating margins will reach 25% after the third year, since they are already at about 19%. As Netflix gets bigger, their content spend as a percentage of revenue will decrease to about 50% of revenue from the 60% currently as they achieve greater economies of scale. Therefore, assuming a 15% revenue growth rate per year for the first 6 years and 10% per year for the last 4 years, we get an intrinsic value of $152 billion for the equity of the entire company, or $334 per share using the diluted share count. Now let's see if this number makes sense. The projected revenues in 2030 are about $85 billion. Remember how Netflix's global revenue per user is expected to grow about 3% per year? By 2030, it should be about $15 of revenue per month per user, which would mean that there will be about 470 million paying Netflix subscribers. Given that there's already 200 million and that Netflix has just barely reached the Asian market, I think this is a reasonable estimate. Furthermore, the global streaming industry is expected to reach about $200 billion per year in revenues by 2030. So as long as Netflix can keep about 50% of the market share, which is what they have now, $85 billion in revenue would make sense. This intrinsic value is well below the current stock price of $564. So I invite you to make your own judgment of whether or not these inputs make sense, and consider for yourself what price you would be willing to pay for Netflix's stock. I hope this was helpful. Please leave a like and subscribe if you enjoyed. What stock analysis do you want to see? Leave a comment down below, and I'll see you again next time.